Welcome back to Investment 360. Foreign investors returned to South Africa's bond market in July following the biggest two-month sell-off since 2011. And this as concern eased that the Federal Reserve is poised to reduce monetary stimulus. Tony Bell, CIO of Vunani Fund Managers, joins us in Cape Town to discuss what we can expect from the local and foreign bond markets going forward. So Tony, first of all, talk to us about the local bond environment, and we see that foreign buyers are coming back in a big way.
Bronwyn, yes, the key to the bond markets really are the currency markets. What one has to watch very closely is the trade-weighted dollar. We've seen, as the US economy has softened a little bit into the third quarter, we've seen the US trade-weighted dollar soften, and that has meant that for foreign investors, the South African yield carried looks quite attractive. It's quite a complex and muddled picture at the moment, because in the bond market we've got this significant ebb and flow between risk on and risk off. As soon as there's a hint that the Fed is going to do anything related to tapering, we have risk off, emerging market currencies weaken, we have a sell-off in our bond market. But I think at these levels we're starting to get to very attractive levels both on the currency and the bond market for local as well as foreign investors.
Correct me if I'm wrong, Tony, but we do now seem to have clarity that the Fed will begin its tapering exercise come September, which is on our doorstep.
That is the current understanding, yes.
In terms of September itself, do you think that that is going to have an adverse effect on emerging markets across the board? Remember, we talk about all this excess liquidity that has been in the system, and I'm not sure how many years we've been talking about the mopping up of this excess liquidity, but now it's going to start. Is this the end of the positive momentum towards emerging markets? We talk about this term, the deceleration of emerging markets now.
Not necessarily. You know, the one thing that I've observed over the years is as soon as something becomes quite popular, probably the markets are going to respond the alternate way. Tapering in and of itself is not going to have a huge impact. It really is the way in which Dr. Bernanke positioned tapering that caused the market to be quite upset or
How
become
so,
a little
Tony?
bit
How
disjointed. Sorry?
How so?
The reason behind that was... Sure. The reason behind that was when he made his initial statement, he really gave no clear policy direction. He said if the economy in the US gets stronger, he will taper. If the US economy is weaker, he will add a little bit more stimulus. And if nothing changes, he will stay the same. So what he introduced in that statement was really policy uncertainty. And as I've said before on your show, what the market struggles to price, particularly when we're at an inflection point where we're moving from an environment of central bank stimulus to real economic growth, and the question investors asking themselves, how much traction are underlying companies getting in terms of earnings growth? That policy uncertainty creates a little bit of a hiccup in markets.
Asset allocation in the current environment, where are you leaning?
We've leaned quite heavily towards overweight equities with a hedge in place. We are pro the more cyclical stocks. We've been quite overweight mining for a while on the basis that China would have to restock. That has happened. That China wouldn't implode. And we see the slow grind, but very noticeable and very sort of evidential move towards higher growth as we move into 2014. We've been very light on consumer services stocks and consumer stocks.
Well, that must have served you well in the current sell-off.
Financials.
That served you well in the current
sell-off.
Sorry, say again? The light on consumer stocks.
It has served us very well. Yeah. We do find ourselves very light duration in the bond market at this stage. We're also significantly underweight nominal bonds, and with a bias more towards inflation linkers in the local market, with real yields having picked up quite nicely. We find inflation linkers slightly more attractive on a break-even basis than nominals at this point, but our focus on the equity market has been very much inclined towards or structured towards those stocks where we saw high margin of safety, low PE stocks with a reasonable certainty of earnings growth. the sort of the upset in our market really came about a few months ago when investors had built too high expectation into some of the consumer stocks, and the companies frankly weren't able to deliver the level of earnings growth that the market was demanding. And we've seen that in the most recent season in the US, where financials and healthcare have surprised to the upside, but retailers have surprised to the downside, and
Tony,
you've seen the stocks punished accordingly.
I want to go back to the fact that you have been in resources. Specifically, have you gone for the diversified miners, likes of a BHP, Anglo American?
Yes, to be completely open with you, we didn't have too many Anglos. We had a lot of Billiton. And what we were looking for there was companies, again, with very strong balance sheets, with good free cash flows. Our second biggest bet in the sector was, in fact, African Rainbow Minerals. So our positioning in the sector was Billiton, followed by African Rainbow Minerals. African Rainbow Minerals in particular has served us well in the last few weeks.
How do you see the financial story playing out with that consumer coming under pressure and the fact that you have been light on consumer-related stocks, specifically in retail? What's your financial play?
Yeah. The financial play is really geared towards Old Mutual as an emerging market insurer. We do like the diversity of exposure in the group. And then we've picked a combination of the more, if you like, large name commercial banks in the form of ABSA and Netcor. Standard Bank is also in the portfolios. And at this stage, we are more encouraged by the recent rights announcement by the management and ABLE. We think that's taken away quite a lot of the uncertainty surrounding the stock, and we've got a reasonable position there as well.
How much upside do you believe there is to Old Mutual when you speak of Old Mutual and the fact that you like them as an emerging market insurer?
That's a really tough question to answer, because if you go back to March of 2009, I believe the stock traded intraday at around R4.75, today trading in the region of around 30. We think that the market has re-rated a significant portion of the value potential, so the upside that we see is really to the mid-30s.
So you're hanging on with the life insurance play for Old Mutual. Sanlam, does it feature?
We do like Sanlam. We do prefer Old Mutual there because of its diversity into emerging markets and just the trade on price to enterprise value. Sanlam's a little bit rich for us. We think it's an incredibly solid business. We watch with interest to see how their expansion into India plays out, but on a price to enterprise value basis, we prefer Mutual.
Is there anything out there, Tony, that is a must-have in your book when it comes to equities and buying equities in the current environment? We've often seen the statement that South African equities are looking a little expensive, heady at the moment. Is there anything that stands out as a must-have?
That's another interesting question. Last time I was on your show, we spoke of Telkom at about 1350, and it raised all sort of measure of interesting comments for people that saw the show. At this point in time, I think the comment is fairly made that the market on a PE of 17 is looking a little bit rich. I do think the old adage that picking companies that have a solid earnings underpin, like the commercial banks, BATs, Richemonts, the SA breweries of the world, and then really trying to and building that up for the clients as a core equity position, and then really supplementing or complementing, if you like, that with some of the satellite plays. At the moment we're quite focused on some of the unsecured lenders, particularly ABLE. We do have quite a strong position in Telkom. We have held quite a strong position in companies like Pinnacle and EOH for a while, and we find that combination works quite well for us, because what you don't want in this market is to have too much of your portfolio biased towards companies that can disappoint on the earnings front.
Tony, thanks so much. As always, Tony Bell, the CIO of Vunani Fund Managers, joining us from our Cape Town studio. That's it for Investments 360 this evening.